Market timing and property valuation are critical in determining the optimal timing for an exit and maximizing property value. By understanding market cycles, supply-demand dynamics, and economic indicators, apartment investors can make informed decisions that align with favorable market conditions. Additionally, knowing how to apply key valuation metrics helps investors assess property performance, evaluate market conditions, and optimize their exit strategies. The significance of market timing. Maximizing property value. Selling during a peak market cycle allows investors to capture the highest property value possible, increasing profits. In contrast, exiting during a downturn may mean lower valuations and reduced liquidity. Managing liquidity. Market timing helps ensure that liquidity needs are met without compromising property value. For example, timing a refinance during a favorable interest rate environment can maximize cash flow without selling. Risk mitigation. By monitoring market trends, investors can identify signs of a potential downturn, allowing them to exit or refinance before property values decline. Market cycles. Real estate markets move through cycles, including expansion, peak, contraction, and trough. Investors should consider where the market is in its cycle when planning an exit. Supply and demand dynamics. Local supply-demand factors such as new construction, vacancy rates, and rental demand influence property values. High demand and low supply tend to drive values up, while an oversupply can reduce prices. Economic indicators. Economic factors like interest rates, employment growth, and inflation impact investor sentiment and property value. For example, rising interest rates can make financing more expensive, potentially reducing property values. Net operating income, or NOI, measures the income generated by a property after operating expenses. Higher NOI typically leads to higher property value, making it a key metric in valuation. Capitalization rate, often called cap rate, is the ratio of NOI to property value and indicates market conditions. Lower cap rates often signal a strong market, while higher cap rates indicate a buyer's market. The comparable sales method involves comparing recent sale prices of similar properties. This helps investors gain insight into the property's market value based on local sales trends. Gross rent multiplier, or GRM, is the ratio of property price to gross rental income. It helps investors gauge property value relative to rental income. Monitoring economic and vacancy trends, including vacancy rates, absorption rates, and rental growth trends, provides a clear picture of market demand and property positioning. Analyzing historical trends in property prices, cap rates, and local economic indicators can help investors identify when market conditions are favorable for a sale or refinancing.